Good morning, everybody. Thank you for joining us for the third of our charity webinar series, Every Penny Counts. I'm delighted to be chairing our session today, which is focused on managing cash, a topic that is high on the agenda for many charities and indeed most organisations. So my name is Katie Cooper. I'm an Associate Director within our Business Restructuring team. So we work with not-for-profit organisations and corporates in often challenging circumstances to help find the best practical solutions to issues they are facing at all stages of their growth and maturity. I'm fortunate today to be joined by three colleagues, Tom, Liam and Peter, who will introduce themselves as we move through the session. So for those of you who aren't familiar with our charity update webinars, just a reminder that your cameras are not on and you will be muted throughout. So if you'd like to comment or pose a question, please use the Q&A function, which can usually be found at the bottom of your screen. We are planning to have some time at the end for a Q&A session. So if you do have a question, please do pop it in there and we will endeavour to answer as many as we can. So in terms of the agenda for today, as I'm sure we all of us appreciate, there are many headwinds impacting the sector, which are driven by the economy. So we're going to start our webinar with an economic update from my colleague Tom Robinson, a partner in our Economic Advisory Services team. After Tom, my colleague Liam Donoghue, Director in our Business Services and Outsourcing team, and I will be looking at managing cash and tools available to assist you. And finally, we will hear from Peter Lewis, a Senior Manager in our external NFP audit team, with insights gained from our recent research into compliance with reserves policies. So without further ado, I'll hand over to Tom.
Good morning all. My name's Tom Robinson. I'm a partner at BDO and an economist for the firm. My primary role is providing expert input to the firm from an economic perspective and expert witness and consulting services to my outside clients. I'm going to be giving a snapshot of the UK economy in 10 minutes, no less, and its interaction with the charities sector today. And I will start with a brief snapshot of the economy in general. We're almost a year on from the Truss Kwarteng experiment, or perhaps exactly a year on from the Truss Kwarteng experiment, which was particularly ill-fated. While the economy can be described now as more stable, it would be quite a leap to describe it as healthy. Good news is that, contrary to what was expected some months ago, is that the economy has narrowly avoided a recession, although I'd describe the economy at the moment as stagnant rather than booming or in any way recovering. Post-tax income for individuals has fallen on average. Prices have risen, and although inflation is coming down, that's now from a pretty high base. We'll get on to the impact of that in a while. One factor which has worsened perhaps only modestly is unemployment, which remains historically quite low. Interest rates going up, as they have done, tends to be correlated with rising unemployment. And perhaps that's only just now starting to bite on the right-hand side of that graph as we headed into summer, which is the most recent data. So overall, probably not the most healthy picture. It is worth stating that international comparisons have recently been somewhat debunked as we revised our post-pandemic growth figures by around 2% last week. So notably, we have recovered our pre-pandemic economy size, a relatively low bar in my view, and further are well now in the pack internationally rather than lagging behind it. There is a word of caution, though. This arose from a change in methodology around estimating economy size, and other countries other than the US, which already uses this method, may make similar revisions to the methodology and pull away again, but we will see. Moving on to projections, a forward look. Inflation mathematically has been almost certain to come down from its peak earlier this year. I mean, when you get politicians promising that they will halve inflation, they normally do so knowing that inflation is going to halve. This is what happens when you have a shock caused by the emergence from COVID lockdowns and the war. Most notably, it impacted energy prices. GDP growth, however, is expected to be pretty stagnant and pretty flat for the next couple of years. In terms of how inflation feels, we've had a real squeeze on the cost of living, people's disposable incomes, which has fallen quite substantially to levels that we haven't seen for quite a few years. This is certainly something that's going to take a while to dissipate. Reason being that it's the cumulative effect of inflation, compared to the cumulative effect of pay increases, which is relevant when considering how people feel about the affordability of their daily lives. So given that huge spike in inflation and the fact that inflation is going to remain high, it's going to take another year or so for the feeling of being poorer to fall away for individuals, probably longer. Let's not forget as well that one of the biggest impacts not captured in CPI inflation is mortgage costs, which are slowly going to come through as people fall off of their fixed deals. So people will feel poorer for a good while yet. Indeed, much of this is dependent on Bank of England interest rate behaviour. Interestingly, Hugh Pill last week, the Bank of England chief economist, indicated that he sees base rate being like Table Mountain was the analogy he used, rather than a peak and then a drop. In other words, maybe a modest rise from here, but then a sustained high interest rate environment rather than a rise and then a drop. Given what he said, it probably does make sense, given the prevalence of fixed deals, much more so than at any higher inflationary period in the past. It takes time for rate rises to filter through into the real economy. However, that longer tail of higher interest rates does reinforce my opinion that it will likely lead to a recession, or at least a continued squeeze on the cost of living and a longer period of relatively low growth and stagnation, probably compared to our peers. But speaking of the Bank of England, this is potentially where we do have a real issue in terms of the longevity of this slump, if you want to call it that. One of the key factors for a central bank is credibility. Credible that they will be proactive and effective in monitoring accurately, understanding, and tackling inflation. Sadly, the past year has shown the Bank of England to be found wanting in this regard, at least since the Truss Kwarteng debacle of last year. And nowhere is that more stark than in the financial markets assessment on rate expectations going up and up. Financial markets do not appear to simply not trust the Bank of England anymore, as you can see in that central block, anymore to control inflation properly or adequately. This is something of a self-fulfilling prophecy, because it leads to less well-controlled inflation. It leads to market volatility and turmoil that itself feeds into the real economy, inflation, and business confidence in particular. So you see markets forecasting differently to the Bank of England. And from the start of the year, the expected trajectory for rates has gone up and up, more steeply than perhaps would have been envisaged by the bank. As such, and given the lag that occurs between increasing rates and the economy, with respect to things such as fixed mortgage deals, I wouldn't rule out a recession should interest rates get much higher and their effect feeds through. So what impact does this environment have on the charity sector? Rather interestingly, interestingly for an economist, there historically has been some correlation in recessions between charitable giving and the economy. But recessions have tended to lead to plateaus, and falls in real terms, but plateaus nominally rather than falls. COVID was slightly different because of the depth of the fall in GDP there, but because incomes were largely protected, the depth of the drop in charitable giving wasn't as steep as one might expect, given the fall in the economy. However, this recession or stagnation or whatever you want to call it, where we are at the moment, not technical recession, real incomes have been hit really quite hard, even if we're not technically in recession. Looking at research by the Charities Age Foundation earlier this year, it really zeroes in on the fact that people feel and are less well off than they were a year or two ago. To a certain extent, this is obviously going to clearly impact the cash available. Across 2022, 69% of people indicated they would need to make cuts to their spending to help manage bills, including 17% who are likely to cut their charitable donations. 25% additionally reported that they had made or were considering changing their charitable behaviour, including cancelling regular donations or choosing not to make one-off donations. The peak of this change in behaviour, the switch point, appeared to come in October 2022, which mirrors the inflation spike of 11.1% in that month. And it was more common in that month, notably compared to previous months, that people would consider reducing the amount that they would give to charity in future. Coincidentally, or not necessarily coincidentally, That coincides with when the Trust Kwarteng experiment pumped rates, increased the expected interest rates in the future quite substantially before they corrected somewhat afterwards. And just as importantly, although we've seen profits at corporations increase substantially, particularly in the FTSE, in listed companies, donations by those corporates have remained relatively flat. So where those excess earnings are not going into workers' pockets for them to donate, they're staying with corporates and they're not proportionately feeding into the charitable sector. This slide shows that charitable incomes, as a consequence, have had a kind of structural shift since the COVID pandemic, which shifted them away from their long-term trend. What this tells me as a non-charity specialist, but someone looking in, is that the new normal overall is no longer tethered to those historical trends. It has a new and somewhat lower trajectory. And I would posit that this lower trajectory will continue until real earnings catch up and start growing and we recover those, real earnings catch up with where they were prior to the inflationary boom, and they start growing at pre-pandemic rates. People and corporations will give less as long as they perceive pressure and uncertainty in terms of their cost and earnings ratios. Charities, as you can see on the right-hand side, according to a survey by the CAF, appear to be concerned on average. And as a double whammy, the demand for charitable services will likely at least stay level, and if not increase. And so overall, this is an additional cause for concern, one which is being acknowledged but not substantively addressed by central government in their spring budget. Food banks and other sort of supportive services are clearly high-profile examples of this increased need. So I'm sure it won't come as a surprise to you all, but in my view, the difficulty of the past few years is somewhat inevitably going to continue. It's tethered not necessarily to GDP figures, whether we're technically in recession or anything like that. Rather, it's determined by how well off corporates and individuals feel. And in my view, we have a bit of a journey to go on here in terms of the impact of base rates, how they filter through to people's disposable income and the general cost of living. That's all I have for today, but thank you very much.
Many thanks, Tom. That was really, really helpful. So in this section, I'm going to be looking at some of the areas to consider when managing your cash flow. But firstly, I wanted to share this next slide with you, which we actually used in our last webinar on optimising your charity's cost base, because it helps set the scene as to why managing cash is so high on charities' agendas. This chart shows some analysis we've done on the level of deficits that charities are running, as taken from their most recent financial statements. It splits charities by size and considers the proportion of a deficit in comparison to its income. And really what it clearly shows is that around half of the charities are in a deficit position, with a larger proportion of those with turnover under 50 million are suffering greater deficits, where expenditure is 120% or more of income, which we've classified as being unsustainable. Now, this clearly feeds into the need to review the cost base of a charity or look to maximising income, the topics of our first two webinars, but it also reflects the need to monitor cash. Put very simply, cash is the lifeblood of an organisation. Whilst balance sheet strength is important, the most common catalyst for potentially terminal problems is a shortage of cash resources. And if cash outflows for costs are higher than cash inflows for income for a sustained period, then the level of available cash and reserves will clearly be depleted. Next slide, please. Okay, so some key areas to consider in managing your cash flow are, well, firstly, trustees have the legal duty to manage the charity's resources responsibly, and a vital part of that is ensuring that they understand the cash position of the charity and ensure it's effectively monitored. This sounds straightforward, but with more complex or decentralised operational structures of groups, of entities, including trading subs, for example, it's important that strong internal controls for reporting and monitoring are established and adhered to. The added complexity for charities is the need to account for restricted funds, ensuring that appropriate funds are used for the correct purpose. So both the purpose and quantum are important metrics, a point that my colleague Liam will touch on later. So we know from our clients there's been a general contraction in funding available for unrestricted operating expenditure, with funders focusing on more specific restricted projects, which is creating a real cash challenge. So when you're reviewing cash requirements, it's important to maintain distinctions between unrestricted cash available for operating costs and funds not available for non-restricted purposes. Each organisation will have its own unique working capital cycle, depending on your sources of income, the work you do, and the contracts in place. But investigating and understanding how you can maximise the amount of cash you have flowing or stored at a particular time is key to managing cash levels. For example, can you bring forward contract payments or negotiate payments in advance, essentially shortening your debtor days? Or can you responsibly extend payment terms to creditors? What happens if, for example, you suffer from a large bad debt or another shock occurs in your supply chain? Do you have easily accessible reserves or facilities available to weather storms? This is where forecasting is enormously helpful. Liam will talk about tools available, but being able to use scenario planning to predict the cash impacts of certain events or the implications on working capital of taking on, for example, a new project is hugely beneficial. As an organisation, we would always recommend that you have an integrated forecast with an income and expenditure, balance sheet and cash flow statements that you can use to project your cash requirements to the medium and longer term future, so you can ensure there's a clear line of sight to preempt issues. But where you potentially need to monitor cash more closely, it's good practice to have a rolling 13-week cash flow, showing line entries for all cash inflows and outflows on a weekly basis, so that any intra-month or sometimes even intra-day, intra-week cash points can be identified and managed through discussions with key funders or creditors. Again, early flagging is key. The more time you have, the more solutions there are available. Having clear controls on who can not only make payments, but commit your charity to expenditure is key in managing tight cash flow situations. Cash is king, and preservation should be prioritised appropriately. Another area to consider is how your cash management links to your wider policies. For example, reserves. Are you regularly checking that cash is in line with your policy, the level of free reserves you aim to maintain? Peter Lewis will pick up on this point later. It's also worth considering whether your working capital strategy is in line with the trustee's risk appetite. For example, would taking on a new contract with upfront costs that are not recovered until later put a strain on your operating cash beyond what the trustees feel comfortable with? What steps could be taken to mitigate? Can you negotiate an earlier payment profile? Another example is investment policies. Consider the structure of your investments and the opportunity cost of instant access to cash versus longer term investment portfolios. Are you getting the best return possible on the assets of your charity? And now, thank you ever so much. I'm now going to pass over to Liam.
Good morning, everyone. I'm Liam O'Donoghue, a director in BDO's Business Services and Outsourcing team. My team are responsible for the core accounting functions of businesses, from bookkeeping all the way through to financial reporting. This does actually include budgets and forecasting as well. Many of you on this call today will be used to the annual budget cycle, and you will be preparing a one-off budget every year. This is useful, but obviously it needs to be revisited regularly, particularly given the cost of living crisis and the economic environment that we're currently operating in. The forecasts and budgets you need to look at now need to be a lot more granular in detail. You need to look very carefully at the timing of expenditure and the reserves that you have available to do those. So, as Katie mentioned, a 13-week forecast is very useful. If you're looking at a larger capital expenditure, for example, you may need a lot longer period to make sure that you don't go into deficit as a result of a large outlay of expenditure at the beginning of the year. You need to be very careful about accurately managing your cash resources. This therefore means you need to have granularity within your forecasting to make sure that you are going down to the level of each fund that you have, whether it's restricted, unrestricted, designated, etc. These all need to be very carefully considered as to what the purpose of that money is for, whether it can be used for any other purpose, and building that into a comprehensive forecast that covers everything. Each forecast really needs to be a three-pronged forecast with a profit and loss or income statement, a balance sheet, and a cash flow summary to understand when and if there are going to be issues with your cash reserves. Whether or not you've already got a system in place to do budgets and forecasts, you will know within yourselves and within your finance teams. However, if you haven't got one, it's now is the time that you probably need to look at it. And if you do have one, you need to make sure that it's covering everything off that you need. So you will need to very carefully think about the system and continually check and revise the budgets that you have in there to make sure that they're up to date and they're covering everything that you need. This enables you then to plan all your timing of your expenditure, utilize your reserves correctly, and manage your funding applications if there are any, or expedite them if you need to access funds quicker. Obviously, those charities relying on donations need to factor in the fact that donations are likely to fall. There are many systems available that can enable you to do forecasting. You will potentially already have these systems in place, and if you don't have them, there are lots to choose from. So you need to consider carefully what functionality you need from the system. So the key functionalities to consider are whether it links directly to your existing system. How is the data input? Can it easily be imported if it's not directly linked to the system? Can the system actually add any extra value to your reporting requirements to make decisions easier for the board of trustees to actually look at things in more detail? How is data stored? Is it safely stored within the software or within the cloud environment that it's in? Can data be accessed whenever it's needed? And does the system enable you to do scenario planning, as Katie mentioned earlier on? Okay, so this is an example of a forecast from one of the softwares that we use. This one is actually generated in a software called Fathom. There are many, many providers. This one gives a level of reporting ability which enables us to add extra information into financial reporting, which is why I'm showing you this one. So this, on the first screen here, you'll see a month-by-month forecast of the P&L and balance sheet. This is where it has the purple line. This is basically, we've imported actual data from a system, and then after that, it's then forecasting. There are lots of parameters in the background, which obviously needs to be sense checked for each forecast and for each entity. However, once they're in the system and you import data, this system starts to automatically forecast to relieve the burden on yourselves of actually making sure that everything is in the system. You can then sense check it and add your scenario analysis to make it a lot quicker and more cost effective for you. If you can go on to the next slide for me. This page covers the cash flow element. So every item within the profit and loss and balance sheet, as you all know, will have an impact on the cash flow of the business. This statement is the key one around managing your resources. This is needed to understand when your cash is going to come in, when your cash is going to go out. Most budgets often exclude the cash flow forecast, so it's very good practice within this particular economic environment to make sure you have a prediction of your cash so that you know that you have sufficient reserves to meet your working capital requirements moving forward. Okay. The reason I chose to demonstrate this particular software to you is it gives us the ability to add additional graphs, additional KPIs. So you'll see here there's a selection of graphs available to show very visually whether or not the cash flow requirements of the business are being met, whether there's going to be peaks and troughs within that cash flow cycle. So you can carefully look to see whether there's areas you can cut costs, whether there's areas you can get access to income quicker, etc. If you can move on to the next slide, please. This system also allows for any entity to have particular KPIs built into their reporting pack. This is an enhancement to the normal reporting that you would have from your system to quickly flag key areas that those looking at the accounts and financial statements can see. These are areas of concern. You'll see there are areas on here where there are marked with red crosses to indicate that there is a problem that you need to look at. It may not be a serious problem that you need to look at immediately, but it flags to you that there's an issue that you need to look at moving forward and helps with further decision making in the future. Okay. I will hand over to Peter to talk about reserves research. Thank you.
Thank you, Liam. So hi everybody, I'm Peter Lewis. I'm a senior audit manager in our audit practice. I'm here to talk to you about some reserves research that we did recently in conjunction with Charity Finance. So this reserves research we did was we looked at the top 50 charities by expenditure to assess how well they were reporting reserves in their financial statements. So starting with the background to this, the free reserves in your accounts, that should be those unrestricted funds that you are holding, which aren't otherwise tied up by designated funds. So you have designated funds. It could be for fixed assets. It could be for future commitments, future plans you've got. Whereas the free reserves are those kind of unrestricted funds there to support the general objectives of the charity. Now, all charities subject to audit should have a reserves policy as part of their trustees report. We move on to the next slide. And that section of the trustees report should be setting out the level of free reserves that you've got at the year end, the level of free reserves that you want to hold, and then telling the reader of the accounts what you're going to do about the difference between the two of those. And as you can see from this table, in terms of being compliant with disclosing the level of reserves that the charity has got, on the whole, most charities did this. So 42 out of the 50 did disclose that. There are a few who either just didn't disclose it at all, or it was hard to tell what the free reserves were. But as we move down that kind of the disclosure of how much you want to hold, again, that's similar numbers. But then when it gets that disclosure about telling a reader how you're going to get from the level of reserves you have at the moment to the level of reserves you want to hold, that compliance then dropped down quite significantly. And as over half of the charities we looked at either didn't tell a reader how they plan to get from point A to point B, or the wording was very hard to follow and you couldn't really understand it properly. In terms of why that is important, trustees and readers need to understand those free reserves to give a sense of, are the charitable funds being used appropriately? Bearing in mind these are beneficiaries today and these are beneficiaries in the future. A good reserves policy is going to give you confidence that you've got the charity finances, they're properly managed, you're taking care of what you need to be doing, and you have the reserves there to fund current programs and future programs. And trustees, you can use that to sense check the financial strength of your organisation. It kind of helps you decide where your reserves should be investing going forwards based on that reserves policy. So moving on to the next slide. So a key part of understanding your free reserves is making sure the designated funds are correctly stated. So those designated funds should be there to show where funds have either already been committed or been put aside for a future intended course of action. So clearly stuff like fixed assets, you've spent the money, it's gone, it's still sat there on your balance sheet as an asset. And so you don't want that being sat in free reserves. Charities will often create a designated fund to reflect the net book value of those fixed assets. And that's a perfectly good use for designated fund. You also have designated funds for, say, future programs that the trustees have committed themselves to. So it could be investing in new IT technology, it could be investing in a new fundraising campaign, it could be investing in a new service for beneficiaries. And where the trustees put money to one side to meet those future spending plans, having a designated fund, again, is a very sensible way to make sure your reserves are presented sensibly in your accounts. However, designated funds should not be used for operating or contingency reserves. And you can see that kind of halfway down the table is about £42 million, those 50 charities that we looked at. So these charities are creating a designated fund for, just in case there's a problem, we've got a pot of money put to one side. That's not the idea of a designated fund. That's what your free reserves are meant to be there to cover. And so then, having understood that charities may not necessarily be reporting designated funds correctly, we then went on to look to make our own assessment of what free reserves should be in each set of accounts of this top 50 charities. And as you can see from this table, the results weren't that good. So of the 50 charities, we felt 36 of the charities were incorrectly reporting free reserves. And it doesn't necessarily mean it's wrong, but this is solely based on what is in those accounts. So if a charity hasn't explained what designated funds are being held for, we would say it shouldn't be a designated fund, that should be part of free reserves. And so you can see from that level of reporting, level of transparency has not been good. And the key bit, I think, for this, for trustees and the senior management team of the organisation and of readers of the accounts, is it makes it very hard for you to really get a feel for the crunch pot. The free reserves is almost like a liquidity measure It's a rough liquidity measure for a charity. So that free reserves target should bring in the cash you need to fund future operations, to respond to threats, to respond to opportunities, taking account of working capital needs. And if you say we've got a target of holding £5 million as free reserves and we're only holding £3 million, that's saying to me as a reader, you've got a funding problem here. You're underfunded. You're £2 million short. You need to get that cash in from somewhere to improve your reserves going forwards. Alternatively, if your policy says we should be holding £5 million, you're actually holding £10 million, then you've got excess reserves. The trustees, the senior management team can then start thinking about how can we invest those excess funds strategically for either the long-term good of beneficiaries or the needs of the current beneficiaries. So it could be investing in new services for beneficiaries, investing in new fixed assets, maybe investing in a new fundraising campaign. They've got the money there to respond to it. But I think the worry for me is looking at this table here where we've got 36 out of 50 charities not reporting their free reserves accurately. How are the trustees and senior management team making those key decisions about future use of cash when they don't understand what their reserve should be? So I think that's my takeaway from this is when you're thinking, people are coming to you and saying, we would like this charity to invest in a fundraising campaign or invest in this activity. The starting point's got to be, what are free reserves? What's our free reserves policy? Can we afford to do that? Is this the right use for our charitable funds? And I think that covers my section.
Wonderful. Thank you ever so much, Peter. And I'll just ask my other colleagues to come back on screen. Now, looking at our Q&A box, it's looking rather empty. So if anybody does have any questions, maybe if you could just sort of pop them in there, or maybe give a minute or so. But whilst you're thinking of any questions, if I can just let you know about the next webinar that we are planning to have on our Every Penny Counts series. That's going to be focused on creating a compelling employee value proposition, which is sort of aimed at attracting and retaining the right employees, which was a really key theme when we spoke to lots of charities when we were recently at the CFG conference this summer. So I do hope that many of you were able to join my colleague David Ellis on the 17th of October. If you're on our mailing list, you'll receive reminders about this webinar, but please don't forget that you're also able to see recordings of this and our previous webinars on our BDO website as well. Okay, I can see we've had some questions come in, so if I just have a look at these. Okay, so the first one we have is going to be for Peter. So is there any way for you to feed back to those charities who have calculated incorrectly? Presumably easier if or where BDO is the auditor.
Absolutely. I think I don't think BDO will be going out to every one of those 50 charities saying this is what we think of you. But I do think the 50 charities, all charities, should be saying to their external auditors, what do you think of our reserves policy and our disclosure in the accounts? Is this ticking off what is required from a compliance point of view? And then internally, it's then for the trustees and senior management teams to make sure they really understand how those numbers have been arrived at. You often see accounts saying, our target is to hold 6 months worth of operating expenditure as free reserves. And from a compliance point of view, that's absolutely fine. You're ticking a point if you're telling people what you want to hold. But behind that, I would expect the charity to have an analysis of why 6 months is the right figure to hold. It shouldn't just be a default 6 months is the right figure. It should be analysis of we need this for working capital, we need this for opportunities, we need this much as a contingency should there be problems. And bear in mind, we've had COVID, we've now got a cost of living crisis. If you need a contingency, now is kind of the time you would need it. So don't be surprised if your current reserves are lower than your target because you're having to use that contingency at the moment. So I kind of think I've answered, maybe gone around the corner a bit on it, but it's, yeah.
That's brilliant. Thanks, Peter. We've had another question come in, which is probably aimed at you as well, I'm afraid. So I'll just read it out for you, and anyone else can jump in if they wish to. This is an attendee. So due to historic issues, we have negative unrestricted reserves. Is it possible for us to still have designated reserves? We have just launched a new strategy and would like to designate some new unrestricted income towards our strategy.
The simple answer to that is no, but it may not be that simple. So you can only designated funds out of as for your unrestricted funds. So if your total unrestricted funds are negative, you can't create a designated fund out of it. Having said that, you need to understand why your unrestricted funds are negative in the first place. There are lots of charities where the pension deficit causes unrestricted funds to become negative. And the Charity Commission has issued some very helpful guidance on this and said you need to understand your plans for funding that pension deficit. If you're going to fund it from existing reserves, then you knock the pension deficit off your unrestricted funds. And if that's negative, then you can't create a designated fund. However, if your plan is to fund that pension deficit from future operating surpluses, then you can treat that separately. So kind of separate out that pension deficit, see what's left in unrestricted funds. If that is then positive, you then can create designated funds out of it.
Wonderful. Thanks ever so much, Peter. I hope that's answered your question. We have one other sort of last question, which is, what's the best advice for budgeting in periods of so much uncertainty? So if I start, and then maybe Liam can jump in as well.
Yep.
So for me, my best advice really is being prepared. So just really having that forward look and using some really good comprehensive forecasts to be able to do some scenario planning. I think the points that Tom was bringing out in his sort of presentation around looking at inflation rates and wage growth, just looking at those real base assumptions in your forecasts and looking at sort of what the impact of those are and what the if that changes as well. So for me, it's looking forward, it's having a proper granular look at all aspects of your business and putting that into a really good flexible forecast.
Absolutely
just to add there, if you don't mind, there are I haven't seen this being implemented in the charities sector, although I imagine it possibly is in some of the larger ones. But there are lots of, when the uncertainty is economic in nature, there are lots of techniques that look at the way in which the economic environment, the way that variables, inflation, interest rates, and things like that impact on factors that determine, you know, your budgeting. So there is analysis that can be done that sort of quantitatively defines what's likely going forward. We do a lot of work in the financial services sector in this space that looks at stuff like expected credit losses, but one could quite easily adapt that type of methodology to look at things like charitable donations or the use of charities functions.
Great, thanks, Tom. We've had a question come in for Liam as well. So we were talking about the integrated forecasting tools. Could you just confirm the name of the software that you were demonstrating, Liam?
Yeah, so the software that I demonstrated was Fathom. It does have the ability to be integrated into certain softwares, mainly cloud-based softwares where there is a direct link to import live data. It does, however, have an option where you can import from spreadsheets. So if your system can download the key reports into spreadsheets, there is a way of importing that. It's slightly more onerous on you because you have to make sure you're in the right format to get the import to work, but it is still possible to use that. So the one that I demonstrated was Fathom, but there are others that would have similar functionality, and a lot will depend on the level of detail you need, but also what system you're using, because there may be other versions or other systems which would link directly with your system, which would make it easier. So there's quite a few things to consider, but the one that was on the demonstration today was Fathom.
And I think the person who sent that question in, please do feel free to contact us. So all of our contact details are, on the screen at the moment, and they'll be in the slide deck. So please do feel free to reach out to us. I think we've got time for one last question that's come in. So it says, some charities are very reliant on local authority funding. With news yesterday of the situation with Birmingham, do you think charities should be more concerned about getting payments from local authorities and longer term planning? So if I take that one, I think, yes, it is, and this all forms into your your cash flow planning and the forecasting as well. And I think, yes, it is right that you look at kind of making sure that from a long-term perspective that you're able to manage those sort of bumps in the road or the weather storms that I sort of mentioned previously, and how any delays in payments from your main funders or who you have your contractual parties, what delays those will have on your overall sort of cash requirement. So I think we're coming up to time now. So thank you so much firstly to the presenters, to Liam, to Tom, and to Peter for presenting, and to you for joining us. As I said before, a copy of these slides will be available, and there's also going to be a short sort of survey that we've asked you to complete. We're really grateful if you could. It provides a really helpful insights for us. It should only take a couple of minutes of your time. So without anything further, I just want to say thank you again, and look forward to seeing you at our next webinar. Take care. Thank you.